People really don't know what their expenses will be because they don't know how long that they're going to live.
Americans are worried they won't have enough saved for retirement now more than ever.
Retirement is going to cost, for many folks, over $1 million.
Is no sure thing in investing, but a lot of people think that annuities may come close to that.
It's going to more safe things that they know. If they know they're going to need that money to supplement their retirement, well, then you can't play that risk.
This is the Safe Money and Retirement Show with Jon Heischman Sr., founder and partner of Heischman Financial Services, serving the Columbus and surrounding areas. Jon specializes in educating pre-retirees and retirees about safe money strategies and ideas. Now, it's the Safe Money and Retirement Show. Here's Jon Heischman Sr.
In retirement planning, we have to address the importance of tax-efficient distribution. Welcome to the Safe Money and Retirement Show. I'm your host, Jon Heischman. I want to talk about that because it's very important and many times overlooked. Although individuals will no longer incur payroll taxes in retirement, it's important to consider that most assets have liabilities associated with them upon distribution, and these taxes may be significant. So, as a retirement planner, I need to be able to help clients determine how to best incur these liabilities over time. I have to apply careful planning that can reduce these overall tax burdens, therefore increasing the value of the assets that are going to remain in those accounts because they're going to be needed later on in retirement. This should always be the goal, maximizing after-tax dollars. Where individuals invest their assets, whether it's in taxable or tax-deferred or tax-free accounts, and in the order in which these assets are distributed can have a significant impact on the amount of after-tax income generated and in turn on a portfolio's longevity. Most research points to the benefits of assessing retirement assets in a specific order. It's kind of a three-step process and could vary depending on where a retiree's accounts are. Meaning, is the money in taxable accounts or tax-deferred accounts? And number 3, tax-exempt accounts. I want to break down each of these to give you a better idea so you can be thinking of where your money is in which type of these accounts. First, taxable accounts, taxable savings accounts. And although the individual will need to sell investments, might have to pay capital gains tax on any appreciation, if you held the investment for longer than a year, they're going to be taxed at long-term capital gains rates, which are significantly less than ordinary income tax rates. Also, using their taxable assets first allows their tax-advantaged accounts to continue growing tax-deferred. Very important. Number 2, withdrawal from tax-deferred accounts. In this category could be IRAs, annuities, and qualified retirement plans. And third, withdrawal from tax-exempt retirement accounts such as a Roth IRA, or if you have a Roth 401k, this will work. Qualified withdrawals from Roth accounts, they're not going to be taxed, as most of you know, which makes them valuable later in retirement. Also, Roth accounts can be used in estate planning because beneficiaries won't owe income tax on distributions. This order of distribution is thought to be the best as it taps the least tax-favored assets first, while retaining benefits of tax deferral for as long as possible. We also have to keep in mind longevity, making sure the money is going to last the rest of your life. Growth is so important for the money sitting in those accounts that are paying income to provide income later to help solve that longevity problem. What I like to do is help direct these concepts to make sure you're in that position or make some adjustments. That's going to help you achieve tax-efficient distributions. 888-426-0177. That number again is 888-426-0177. I'd like to hear your feedback, your questions, your concerns, and possibly provide advice for you on tax-efficient distributions. And don't forget that taxation becomes even more complex when we consider other issues such as the taxation of Social Security benefits. And if your Social Security is susceptible to taxation, that's where I want to make sure it's included in designing the income plan. Now, earlier I mentioned the longevity problem because the majority of retirees fear running out of money in retirement more so than they fear death, regardless of the distribution method that's chosen. Strategies that I've discussed here are designed to eliminate that worry. When you have definite distribution plans, it's also going to give more confidence and be able to obtain financial independence. And also keep in mind that income strategies, they're not a one-size-fits-all. The bottom line here is that you need to integrate approaches and use different products to create an efficient retirement income plan. I determine whether the goals of a client are asset longevity, wealth transfer, or possibly a combination of those two. So after considering your needs, I can then identify which of the available decumulation strategies are best suited and to meet your needs. And the right decision, it's dependent on a number of variables, such as interest rate, stock prices, assumptions regarding inflation, your future income needs, and also life expectancy. Perhaps most importantly, I must help each retiree by monitoring the chosen plan as they move forward in retirement. Very important to track changes in lifestyle, each individual's goals, and make changes to the plan if necessary. Attention must be made to changes such as higher than projected levels of spending may need to be discussed with each retiree and help them understand the risk associated with depleting assets before a certain age. I know I always try and keep my clients informed of changes that affect their current retirement plan, not only on the short term, but also on a long-term basis, and how those implications may change, allowing them to make necessary adjustments to put the plan back on track. Then, if necessary, modify the plan, and if not, continue with the plan and review again in the future. I think the plan should be reviewed once a year during an annual meeting. What's working today doesn't necessarily mean it's going to be working in the future because of taxes, healthcare costs, and inflation. Before I take a break, I want to give you my number once again. It's 888-426-0177. I'll repeat that, 888-426-0177. Visit my website, which is heischmanfs.com, HeischManFS.com. Any information you'd like to have, you can call that number as well. Maybe it's Social Security. Maybe it is a Roth conversion. Let me know. I'll get information out to you, any pamphlets, any books that will help your concerns and make another step towards a more secure retirement. Stay tuned for the second part of the Safe Money and Retirement Show. I'll give you some more ideas and things to think about after the break.
Thanks for listening to the Safe Money and Retirement Show with Jon Heischman. For more information, call 1-888-426-0177. That's 1-888-426-0177. Or visit their website at HeischmanFS.com. More of the Safe Money and Retirement Show in a moment.
The goals of good retirement planning are to help each individual to end up with more money at the end of the day, but also provide more income during retirement. And this creates a less stressful investment experience, especially in times like this. I like to emphasize and stress stronger financial understanding. Not only could you have greater wealth, more income, and a better night's sleep, you should also have a stronger grasp of your own financial standing. With a strong retirement plan in place, you're going to know exactly what you can withdraw from your retirement accounts every month, how much you need to live comfortably, and how long your savings is going to last. This is Jon Heischman, your host with the Safe Money and Retirement Show, 888-426-0177, 888-426-0177.
Welcome back to the Safe Money and Retirement Show with Jon Heischman. To contact Jon, the number to call is 1-888-426-0177. That's 1-888-426-0177. Once again, here's Jon Heischman.
Welcome back to the second part of the Safe Money in Retirement show. I'm your host, Jon Heischman. Let's talk about the problem of having too many plans, because most retirees do not have a single retirement plan. They have several, one or two, maybe more IRAs, possibly a profit-sharing plan, maybe a defined benefit plan. How do you calculate the required minimum distribution, given the fact that eventually you're going to have to take distributions from all of these qualified plans? And here's where you have to be careful, because the more plans you have where you have to take minimum distributions, the more potential for a problem. They're easy to miss. And as you may know, there is a heavy tax if you miss that RMD in a given year. What I like to do is have my clients' RMDs set up on what we call a systematic RMD each year, whether it's paid annually. And by the way, November is the largest month for RMDs to be paid out. But whether it's annually, quarterly, or monthly for income, I have the company set it up systematically. So each year we let the company figure how much you have to take, because it does vary from year to year. What that does, it relieves the liability on my clients as well as myself. And we let the companies handle that, because a lot of these companies will have a whole separate required minimum distribution department. There could be 10 to 50 employees just in that department. So that'll solve that problem. Now, the IRS will allow a certain amount of aggregation, but only so much. Each IRA's required minimum distribution has to be calculated separately. The total required minimum distribution can be taken from any one or several of those IRAs. The same aggregation rule applies to a 403B plan. Every other type of employer plan must individually make an RMD. In other words, distributions from employer plans must be calculated on each plan and withdrawn from that plan. What happens if you're one of those retirees or getting ready to retire, and we're designing an income plan and we're looking forward to the time that you're going to have to take those required minimum distributions? You may have 3 IRAs, a 401k plan from a previous employer, maybe a 403B from your current employer. Sounds like a good problem to have, doesn't it? But it can potentially create a big problem in the future. Many individuals at retirement or prior will combine retirement accounts. And by doing this, it really simplifies and eliminates those potential problems, because now you might have one IRA and one 401k. Of course, that 401k needs to be rolled over to an IRA. I see a lot of individual retirement accounts, IRAs, that are older contracts in annuities. They are outdated. They don't provide the guaranteed lifetime income benefits, and the interest rates may be low. So when I talk about combining IRAs, these annuities can be combined into one, which is up to date with the potential for more growth, and you can include the guaranteed lifetime income benefit. So what I have to do is to review those contracts. And if you're thinking of combining them, I've got to make sure it is in your best interest to replace those into one new annuity contract. The other thing I don't want to forget about that, the new contracts could also include some long-term care benefits, which of course is recommended in the retirement plan. And again, if it's in the client's best interest to make that move to combine multiple annuities into an updated annuity, it could work, and it's something that you really need to look into for those of you that have multiple contracts. And let me know. I'd be happy to do an annuity review, see where you're at, and if there's potential for bringing those accounts up to date, which could be better for you. 888-426-0177. Again, 888-426-0177. Okay, I want to go back and give you an example of a potential problem with required minimum distributions that I had been discussing. So let's call this individual Frank. He has 3 IRAs, a profit-sharing plan, and his company's defined benefit plan. So after figuring the RMD for each of the IRAs, he can take a distribution from 1, 2, or all 3, as long as it matches or exceeds the required minimum distribution for the total of all 3. Then we always have the problem of who's going to figure what the minimum is that that individual has to take. And it gets a little bit more detailed, but it can be done taking just one RMD, which will satisfy all 3 of those contracts. Now, don't forget, there's a couple other plans that Frank has, and he must take RMDs from each of those other plans. He cannot aggregate plans when he makes the RMD calculation, nor can he take a single distribution from 1 or 2 of those plans. So the importance of getting it right and how this can be a little bit complicated can't be stressed enough. And that's why I want to make sure my clients are doing it right and doesn't put them in a bad tax and or penalty situation. Another problem is, let's call this person Steve. He missed a required minimum distribution because he withdrew less than what the minimum was. His penalty for taking too little amounted to a pretty substantial amount. Therefore, he'll have to make that up and also take the minimum, the correct amount, the next year. Here's another real problem. So the point is, let's get it done right. Not only the first year, but every year thereafter. Again, as I said earlier, I like to have the companies where those accounts are figure the RMD each year. Therefore, the liability is on them. And I got to tell you, in my many years in practice, I can't recall where a company had miscalculated the RMD for a client. For those of you that this applies to or will, make sure these distributions are set up correctly and eliminate the potential for errors, taxes, and penalties by possibly combining these qualified accounts into one or two. I welcome the opportunity to talk to you about your potential problem, as well as combining those older annuities that you have. 888-426-0177, 888-426-0177. As always, I appreciate you joining me. My goal is to give you ideas for a better, safer, and more secure retirement plan.
The Safe Money and Retirement Show with Jon Heischman Sr. To get in touch with Jon, call 1-888-426-0177. That's 1-888-426-0177. For more information about Heischman Financial Services, visit their website, HeischmanFS.com. That's HeischmanFS.com. Join us again next time for the Safe Money and Retirement Show with Jon Heischman Sr.